Nick Paulson, India head with Espirito Santo Security, joins us live with his fundamental take. Nick, good morning. Thank you for joining us. Well, Christmas has arrived 2 weeks early. How should one approach today's gap-up start?
Well, I think as other commentators have been saying, clearly you have a lot of enthusiasm for political change, and the exit polls suggest there's going to be a change in government. I think it's a good thing. I think it's another factor which probably means an okay outlook for 2014, but I think one needs to be careful not to underestimate some of the structural challenges that the economy still faces. That political change in itself is good, but it takes time for that to then feed through in resolving some of the challenges the Indian economy faces and frankly emerging markets face in 2014.
So would you be a seller now? Because if your underlying thought is that the structural problems for emerging markets and in Indian economy are not over, and if stocks have already seen some degree of run-up ahead of the bend in the road, is it time to get out?
No, I don't think it is. I just think you need to just, within your investment framework, just be mindful of the risks you face in 2014. I think the combination of enthusiasm for political change, a gradual recovery in the economy next year and a gradual recovery in the earnings cycle, the fact that fixed income as an asset class is unattractive is likely to be in a sustained bear market, so equities are going to receive the bulk of flows. And also developed markets have had a very, very good year this year and so look expensive. I think that means that gives you a reasonable outlook for 2014 in terms of equity markets. And it's logical to, given what's going on, to add a little bit of cyclical exposure. But I just think one needs to just be mindful that don't chase too much beta, don't take too much risk in portfolios. Some of the themes we've seen this year around export-orientated stocks, things like that, I think those will persist, and I think the rupee will remain relatively weak. So it's more in case of I'm not negative on equity, I'm just probably there's a degree of caution on the overall outlook.
Nick, how are you approaching the other event, which is the jobs data? And if indeed it's positive, the kind of commentary that we are likely to hear from Fed on account of tapering, could that turn out to be a bigger event than domestic politics for India?
Yeah, I think for all emerging economies that we're going to have this waxing and waning of tapering and the impact of tapering. It's caused material outflows in terms of fixed income. But I also think if you look at this year, since March, one of the biggest themes has been the slowdown in emerging market economies in terms of the consensus forecast. I mean, India over a 12-month period, the IMF's forecast for India decreased by 2%, and a lot of this is just liquidity being sucked out of emerging markets already as bonds start being repriced. So it's not just a cyclical and fear factor in the market, it's a real factor which is going to be a major, major headwind for emerging market growth. So to a certain extent, one could say some of it's priced in. People often, some commentators would say that the same issue doesn't affect a market the same way twice. And obviously we've had a bad run around tapering. The current account deficit has come in, the currency is already weakened. So I don't think it'll be as sharp as we saw in the previous bouts this year. But I think it's still an issue one needs to be very careful about.
Nick, for the last 6 months, the Indian markets have really traded in a range. Nifty has struggled to go past beyond 60 to 50. Nifty always has found support closer to 5,900 and 6,000. Do you think the verdict of state election will be that big event push which will take Nifty to a new high?
I think if you look at it, because you're right, it has traded in this range, and my view has been that it's not going to break out of the range until the fundamentals change. So I'm not convinced that the earnings multiple themselves will increase enough to knock it out of the range of sort of Sensex at 21,500, say. But it does feel like the market wants to rally, and there's so much enthusiasm around political change. So I think it is possible that you get momentum just around the political rally that could break it out of that range. But my sense is probably temporarily, because you'll then have more fear coming in around tapering. So I think until you get more confidence in the sustained recovery in the economy and in earnings overall, I think that's going to be a constraint in terms of the market properly breaking out of this trading range it's been set in for the last 12 months or so. But within that, obviously, you can still see some stocks, some sectors doing well.
Nick, and that's the new theme which has sprung up, right? Power as a sector. What is it that you like out of this space?
Yeah, I think generally enthusiasm for anything, the assumption is a BJP-led government is going to be more investment friendly, so recovery in the investment cycle, so industrials are doing better, and power companies, etc. For me, actually, I think perhaps power finance is something I'd look at. So PFC has been, look at its return profile, it's very cheap, and I think that's probably better exposure to that sector. It doesn't face the same kind of structural challenges around you've still got all the issues around concession agreements, coal, etc. So those issues haven't disappeared. They might improve, but they haven't disappeared. So PFC would probably be my pick there.
Nick, the opinion that BJP will be a pro-growth government is just an opinion. The problems for Indian economy are so deep-rooted that it will be very difficult for any government to turn things around in a short period of time. But the way stock prices have appreciated, markets are expecting that some magic will happen after May 2014.
Yeah, and I think that's absolutely right. I think that's the danger. I think, look, I'm an outsider, I don't vote, so I don't have a political allegiance, but you look at it and you think you couldn't run the country any worse than the current government. So any change, for me, is a good change. So I think a BJP-led government is positive for the country. It's just that it takes time to initiate change. So there's that initial enthusiasm, but then the reality is, look at particularly the investment cycle, the fundamentals of the economy, so issues around land acquisition, highly leveraged private sector, and issues around concession agreements and repricing of those. These are big issues that take time to resolve. So I think you'll have the run-up to the elections and enthusiasm around that. The risk is then some disappointment about the reality that the economy is not going to turn around quickly. We are in a slow economy, and we will be for some time, probably 2 or 3 years of slow growth in the economy. It's not to say it's not recovering, it's just going to recover slowly.
So what is the biggest risk, even if, it is a pro-market, pro-growth government that actually takes charge, and that indeed is something that the market has already begun pricing in? Because we've seen the fiscal side of the market actually easing out, the currency as well as strengthening. We saw the fiscal deficit or trade deficit data come in positively. GDP as well seems to be picking up. What's the key sticky point at this juncture?
I think if we look at our experience over the last year or so, there's often been periods of enthusiasm around the possibility of change. Think about this time last year, lots of enthusiasm around the likelihood of an improvement in the investment cycle. The risk has generally been around when the data comes through and data has disappointed. So I'd say that's the risk, that people just become disappointed around the recovery in the economy and the recovery in the earnings cycle. So I think that's the risk, but I still think, as I said, I think you are going to see a gradual recovery in GDP growth and a gradual recovery in the earnings cycle next year. And CAD has improved somewhat. I think the fiscal deficit is broadly under control. So it's a question of moving in the right direction, but not as quickly as I think that the risk is the market expects it to move too quickly. You get a major run-up expecting magic from Modi, and then the reality disappoints.
Okay, just to set the tone for the market now, it's a gap-up start. Sensex is up by 2%. All key sectors are trading with the positive bias. This is the biggest percentage gain for the Bank Nifty since 29th of October. So cyclicals clearly are leading the rally. Now in the short term, markets are a function of sentiment and technicals and price adjustment. So fundamentally, well, nothing has changed in last 24 hours or last 48 hours. But somewhere the opinion has changed, the sentiment has changed, and more than anything else, I think somewhere a lot of short covering is also at play, because markets were divided, markets were nervous, and short sellers are clearly running to cover the positions. Nick, so cyclical has been the big theme. Cyclical stocks have regained leadership. After an average run-up of about 15 to 20% in cyclical stocks, where would you like to draw the line? Is it time now to cash out?
No, I still think that there are some cyclicals where you can gain exposure to cyclicals and they look reasonable. Some of the private sector banks, I think valuations still look reasonable. Some of the industrial stocks, so let's take an Axis Bank for example. I think often some of the cyclicals which might face specific issues, like for example the consensus expectations for Q3 results on asset quality for Axis Bank and improvement in terms of PAT are relatively subdued, and so it could easily beat expectations. So if you can find, not rather than just playing the overall theme, it's finding stocks which might have some specific issues that people are worried about, where the market might be underestimating some of the benefits. So I still think it makes sense to selectively add cyclical exposure, even now.
So how much of your portfolio would you like to align with cyclicals? When I say cyclical, banks, capital goods, maybe some autos?
Yeah, I think banks and financials overall is 25% of the index, and I still think it makes sense we have a strong weighting towards that. We often do, and I think a mix of larger private sector bank, Axis Bank, and then also I think some of the mid-cap private sector banks like ING Vysya look good value. And I think industrials probably, we would be lighter in terms of our exposure than the market. So I think have a neutral weight on L&T and then selective exposure around that. I think, for example, some of the infrastructure stocks like the ports, Adani Port is obviously going to run today for obvious reasons, but also Gujarat Pipavav Port. I think that looks good going into the new year. And so I think in terms of, so we'd probably be neutral weight in industrials and infrastructure overall.
Markets predictably move almost 6 months to 1 year ahead of what reality is. So is it time to book out now?
No, and remember, most of our clients are large institutional investors, so their time frame of investment is longer. Many of our clients are looking at 3-year time horizons. And so I think there's growing confidence, and I think for us, we have a broadly positive outlook, but as I said at the beginning, I think there's an okay outlook for equities. I don't think it's exciting. I think you're looking at maybe 10 to 15% gain over the full calendar 2014. But you're going to see a lot of volatility, so markets will bounce around a lot around elections. You'll probably see major election day gains, but it's then going to be tempered by reality. So I think that applies to many emerging markets, that they're looking at sort of okay gains of 10 to 15% next year.
So what happens to the spaces which have been doing well, the likes of the consumption theme, FMCG, or for that matter, IT? How does one approach the defensives now?
So I still think export is a theme. I think the rupee is going to remain weak. So IT, you've got a combination of, it benefits from the currency, but also remember that the end markets and discretionary spending are very strong. I just think you have to be more careful. If you play TCS, it's too obvious. Take a stock like Wipro, where it's had 2 years of restructuring, it's had more issues, it's trading at much lower levels, it's sub 14 times FY15 earnings, and I think it's rebalanced itself, it's less exposed to specific verticals like telecoms, so I think you're going to get margin improvements, and it may well beat expectations. Some of the mid-cap IT names like KPIT, Cummins, for example, Persistent Systems still look good. Pharma, again, I think the sector still looks attractive. It's just fine stocks which have had more issues. Cipla, for example, on the MedPro consolidation, had a bad one-off in Q2. I think that looks attractive. And then in autos, I think we favour, again, like the theme of export orientation with autos, but favour the auto component stocks. So Motherson Sumi actually I think looks very good for 2014.
Nick, you've given me about a dozen ideas. Let's nail it down to maybe 1 or 2 ideas where you're okay to allocate 7 or 8% of your capital. And when I say 7 to 8% of your capital, it has to be a mid-cap stock. Okay, so I actually think mid-caps is going to be one of the themes of next year. And within mid-caps, I think 2 themes to look at. One is M&A within the private sector banking. You've seen changes from the RBI. And I think of those, the ING Vysya, it's a very good quality business. Look at the way the management's run it over the last 3 or 4 years.